Okay, perfect. Okay, so we have 42 people at the moment. I think some people will join us very soon. So every time before I start the session, I always want to recap what we learned, what we have learned from the previous session, so that we can recall some of the main concept that we have done together, so that you know have a clear and understand you know the main content um, clearly. Okay, let me share. Okay, uh, yesterday we introduced you the concept of risk and return, and we starting to introduce you that any risky assets uh, uh, are, for example, the treasury bills of the U.S. government bond, the corporate bond, stock, small stock, world portfolio. We can see that the return provided to investor varies. At the same time, we can see also the fluctuation of the returns also different among those different risky assets. Okay, so we start to you know learn how to measure in finance the risk and return. We start by you know, borrowing your high school mathematics, assuming that the possible returns are distributed, okay, with the probability. And then in that case, we're gonna be able to calculate the expected return that used in the form of weights of probability weighted average of those possible returns we have seen already together. And when we know the expected return, we would be able to again use the high school mathematics to measure how spread out of those distribution, and these the way they spread out from the mean, from the distribution, we call it as a variance. And we take square root of the variance, we could get something called the standard deviation. And this standard deviation of stock returns has a term which is called volatility. When people talking about the stock volatility, it means like it means the standard deviation of the returns. Okay, so this volatility, okay, this is one form of how we measure the risk. Okay, I just want to make sure that everybody is with me. Okay, so once you have all those volatility to measure return, we should be able to do the characteristic of the stock, okay, in the form of expected return and its volatility, which is the form of risk and return. And this particular risk has a specific measure, they measure or they proxy, okay, the total risk. Okay, total risk, they don't care what type of risk, but the total risk mean the fluctuation, the movement of those return. Okay, and we can see from the BFI and AMC, and then we also, you know, learn about how we're going to use the historical returns to learn how the stock perform uh, in the past. Okay, we can calculate the average annual return arithmetically, or we can use the compound annual return, which is more common in the form we call the geometric average. Okay, and then and we can see that the risk premium, okay, that corresponds to the level of, extra returns, okay, provided by each risky assets, quite corresponds or has a kind of correlation with the risk of each risky assets. As you can see that there is a kind of interesting linear relationship between volatility and the return, okay, for the large portfolio of risky assets. However, if you look at each individual stocks, okay, like GM stock, American Airlines stock individually, and we can see that all those stocks with the same level of return of the last portfolio, they always have a higher risk, higher volatility of this total volatility. Okay, and also interestingly, there is no precise relationship between the volatility and average return for individual stocks. Unlike the large portfolios, you can find some interesting linear relationship between those volatility and average return for large portfolio, but not individual stocks. Why is that so? We learned that actually in inside the total risk of a security, there are two elements. One which is called idiosyncratic risk, the risk which is diversifiable. And then the second is the systematic risk, which is the market risk, is the risk which is undiversifiable, not diversifiable. Is good or bad when it's not diversifiable? It depends, right? If you want to get the compensation return to hold that type of risk, obviously, you're gonna get return when you hold market risk, but you should not get a return, or the market will not give you a specific return on the unsystematic risk or the firm specific risk or diversifiable risk, because it is diversifiable and diversification is free. Okay, so that is what we learned yesterday about this concept. And then I asked you to look at the problem set number one. Anyone in the room here have done the calculation? Anyone? So what you have to do is to help me to find out what is the expected returns and what is the volatility of each stocks, right? Stock A and as well of the stock B. Anyone have done the calculation of expected return and calculate the volatility of the stock A and B? For the people, I'm talking about the problem set of question number one. Anyone? Perfect. Mantando. I give you bonus points. So the stock A has the expected return. Stock A has the expected return of 5.5. I try to categorize the stock. Perfect. I don't need to type. Chung Kien Tan, thank you. The stock A has the expected return of 5.5% and volatility of 16.27%, whereas the stock B expected return is 32.5% and standard deviation of volatility of the stock B is 323.747%. Okay, thank you so much. So it is perfect. You are great. Okay, so if I count, I can make, for the people who have not done it, I gonna give you the solution of each question on the problem set for you later on. Okay, after we we provide you the answer for all question, or we have done together all of this, and then I can give you as a reference. Okay, you don't need to type it now or write it now. So the Very important one is the question number C. How we interpret, how we read after this calculation, how you categorize the difference between the two stocks. What trade-off would you face in choosing one to hold? Do you have any preference? Do you prefer stock A or you prefer stock B? It's like we do in the BFI, right? The BFI, you say that you prefer the BFI stocks than the AMC stock. Okay, where because the same expected return, the BFI stock, the investor bear lower volatility. Okay, for this category, for this exercise, can you make a conclusion on this or not? How we categorize it? Bantang Do, you're typing. So anyone can, you can talk, huh, if you wish. Anyone want to talk or you can type? So how we categorize it? Stock A, stock B. Do you prefer stock A to stock B or stock B to stock A? B has a higher expected return, but A is safer. Okay. Go with stock A if you prefer stability. Okay. Go with stock A if you prefer stability. If you prefer adventure, go with stock B. In the BFI and AMC, do you need any, we call risk preferences? You don't need, right? Because with the same expected return, you can choose, if you are a rational investor, you should choose the one that has lower risk. Okay, and this one we call the, we don't need the risk preferences as investors. Okay, for the stock A and B, the how you're gonna categorize is very simple. You can just say that the stock A has a lower expected return and has what? Has a lower volatility than stock B. It is very simple, okay? Because the stock A and stock B cannot, you know, make cannot compare. It just only have a different risk profile and return, right? The stock A has a lower risk and lower return, and stock B is higher risk and higher return. Okay, so therefore the choice after you categorize it, if you want to find the trade-off, it will gonna be your risk preference as an investor. Okay, your, we call that, if you are the, let me correct, not correct, but introduce you some other, if you are rate-taking investors, okay, you would probably go for stock B. But if you are, what is the opposite of the risk taking? If you are what? How we call that one? We call risk averse. Very good. Thank you. So if you are risk averse, you would prefer stock A. Okay. As this one, we learned yesterday that you cannot just simply make a pro rata, make a ratio, the level of risk and return, and make to see which one is the best. You cannot do like that at the moment, okay? Because there is no linear relationship between risk return for the individual stocks, okay? Now, any question? So this is the first problem set that I'm very happy that you have done a homework, and then you also understand and we interpret the result of the exercise together. Any question? it's good like this. I talk about theories, I apply in problem set, and sometimes I can ask you some, news that related to the real stock market, and then we're gonna try to see whether the theory that we learn in class can apply to the real world. Okay, can apply in the problem set, and also we can apply also in the to the real world. Okay, if I have any interesting discussion, I can come back and introduce you later. So far so good. Now we're gonna go to a second concept, theories that we're gonna learn together, which is called the optimal portfolio choices, okay, and the capital asset pricing model. Okay, so actually we're gonna try to prove and learn a little bit in depth on how diversification works and how those diversification would allow us to form the optimal portfolio choice. What is the optimal portfolio choice? We're going to introduce you today, and also how these optimal portfolio choice will lead us to get something called the capital asset pricing model, or CAPM, that allow you to derive the relationship between risk and return for the individual stock. Okay, let me start by introducing you that when you form a portfolio, remember yesterday, a portfolio mean you form a basket where you put several risky assets in your portfolio, in your basket. Okay, we call a portfolio. Let's assume that you have different stock. Right now, let's focus on that you have a portfolio of stocks, and then each stock, for example, stock one provide you a return one, and the stock two provide you the return two, and so on and so forth until the stock n, you get the return of n. If you invest, okay, or you allocate your portfolio weight of your total investment. So if you investment uh, uh, $1 million, so you want to put X1 30% on your $1 million in the stock one, and X2 10%, thing like that. How we gonna be able to get something called a return of that portfolio? So the XI that I'm talking about here represent, we call the portfolio weights. And this portfolio weights is equal to the value of investment I divided by the total value of a portfolio. Okay, so example. Okay, I will give you a real example so that you can easily understand it. Suppose you invest $10,000 by buying 200 shares of Walt Disney Company at $30 per share, and 100 shares of Coca-Cola stock at $40 per share. If Disney shares price go up, okay, from $30 to $36 after a period, Coca-Cola share price fall from $40 per share to $38. What is the new value of the portfolio, and what return did the portfolio earn? Okay, if you don't buy or sell any share after the price change, what are the new portfolio weights? Very straightforward. So I have the value, or if I want to know that how much I invest in the RD, which is Disney, and C is Coca-Cola. Okay, so remember I have what? I have $30 of 200 shares, so it become what? 6,000. Okay, I invested in Walt Disney. Okay, which is 60% of my portfolio, and can multiply by the return of my Coca-Cola, the return of my, no, Disney, sorry, the Disney, you get a return of 36 divided by 30 minus 1. Everybody know how to calculate the return, right? The return is 36 minus 30 divided by 30, or 36 divided by 30 minus 1. Okay, you're gonna get the return of your the Disney. The Disney return is 20%, where the Coca-Cola, the return is minus 5%. If you have 60% multiplied by 0.2 plus 40% multiplied by minus 5%, you're going to get 10%. This portfolio generate 10% return. Okay, 10% return of your portfolio. Okay, so what is the new value of your portfolio? So you have the new value of additional 10% of your $10,000. Okay, which is $11,000. With $11,000, if the number of share of Disney and Coca-Cola, you still hold the same, you don't buy and sell extra of these two stocks. So you're going to be able to recalculate the new portfolio weights, which is now your new portfolio contains 65.45% in Disney stock and 34.55% for Coca-Cola stock. That makes sense? Any question? So far, so good? So far, so good? So if someone working in this is some kind of, a job that at least in European market, okay, we do a lot, we call the asset management, right? You manage a part, you are the fund manager, and then you manage and the allocation of the asset for yourself or for your client or for your bank, for your company, and so on and so forth. Okay. So once you have this, okay, if I have the expected return of each investment, I'm going to be able to calculate the expected returns of my portfolio. Just only, if you take into account of those, okay, portfolio expected return, you can calculate the expected return of your portfolio. For example, if suppose you invest 10,000 in Ford stock, 30,000 in Tyco International stock, and you have an expected return of 10% for Ford and 16% for Tyco, what is the expected return for your portfolio? So you can just simply calculate the weight, okay, and expected return. 25% that represent $10,000 over 40,000, okay, which is the total value of your portfolio. You invest 10,000 in Ford stock, it represent 25%. The Ford stock generate 10% of return, expected return. And then you have 75% that represent 30,000 in Tyco. Over 40,000 is 75% multiplied by 16% of expected return for Tyco. So the expected return of your portfolio, if you invest with this type of allocation of your investment, you're gonna get you can expect the expected return of your portfolio goes to 14.5%. Okay. So the first one is real return, and you calculate it, and this one is based on the expected return. Everybody understand that what the difference between expected return and realized return, isn't it? Now, let's go to that if you combine two stocks, two risky stocks, okay, and two stocks inside in your basket, okay, obviously you know how to calculate expected return of this portfolio, very straightforward. However, what is the risk, okay, of this portfolio, okay? And we're gonna learn now how we're gonna measure the volatility of a two stock portfolios. Okay, how we combine the risk of the two risky stocks in the basket, how we compute the portfolio variance and volatility. Okay, so I prefer to give you again the real data, or not real data, examples that allow you to understand things. Okay, let's assume that in the economy, okay, or in my investment opportunities, I have three stocks. One is North Airlines or North Air, second is West Air, and third one is a Tex Oil. Okay, and this is a historical return from 1998 to 2003. Interestingly, what is interesting is the expected return of North Air, West Air, and Tex Oil. Not the expected return. Average return is 10%, 10%, and 10%. Okay, is the average of this, average of this, average of this. Okay, and then interestingly too, that each volatility of these stock is 13.4% for North Air, West Air, and Tex Oil. All three stock have same expected return or same average return and same volatility. All right. So each individual stock, and you can see that even though the the portfolio has a different number in terms of return each year, okay, but at the end they have the same expected return and same volatility. So basically you can see here it's just only the same number. But what we can see as well, what do you see from the pattern of these return? North Air, West Air, and Tex Oil. What do you see? Anyone see something? Do you see something? Anyone observe something from? Everybody can just have a look on this left-hand side of the three stocks. What do you see? Can you observe something on the characteristic of returns? You should. Same return, same risk. That's good. What else? What else you can observe? So you are the top CEO. You see, when you become a top CEO, you don't have much time, but you should be able to identify some interesting observation from the data information when people present to you. Okay, when they present to you on the left-hand side of the historical return, what do you see? Among these same average return and same volatility, what do you see inside the information data over the year? Okay, we call the time series of this data. What do you observe? When oil has positive return, air has negative. If you have two series of data that go quite opposite way, if the oil price going up, the airline business have less profit, right? So they have a negative return. And this one, when you have the series of the data that go to the opposite way, how we measure the pattern of this? In statistics, we call some kind of correlation. Okay, and these correlations between Tex Oil and other two ally company, they are quite negative. They are negative correlation. Okay, between the oil, Tex Oil, and other two stocks, and between the two airline stocks, what do you observe? When it's going up, another going up. When it's going down or negative, other they going down. How we call these correlation? We call it the how do we call it? We call that the north air and west air return are positively correlated, right? Okay, positively correlated. When they are positively correlated, okay, we're gonna see later on that if the correlation may explain or may give us some hints when you're going to form a portfolio, especially when you want to benefit from diversification. Okay, if I tell you later on what the result of this. Okay, let's now try to form a portfolio of the two stock that you can pick up. Okay, you can choose North Air and West Air with the 50% in North Air and West 50% in the West Air. That is my portfolio one, basket number one. And I do the basket number two. Basket number two, I put 50% in West Air and the Tex oil. So I combine this one and this one and this one and this one. Okay, North Air and West Air and Tex oil. What happened is I have a portfolio return. Okay, I just simply use this formula. Okay, I get the return of my first portfolio one and portfolio two. Let's give you the portfolio one and portfolio two. And then I calculate the average return of my portfolio one and portfolio two. Interestingly, what do you observe of the portfolio one and portfolio two? You observe that the average return remain unchanged, right? Intact. They have just exactly the same expected return. However, if I calculate the standard deviation on my portfolio one and my portfolio two, interestingly that my portfolio one, I have the portfolio one with the volatility of 12.1%, which is lower than 13.4% if I allocate 100% of one of these stocks. Even more interestingly, you look at the portfolio number two, the average return remained 10%. However, my portfolio two, the volatility goes down to 5.1% when I combine the West Air and Tex oil, okay, together in my basket, where the West Air and Tex oil has negative correlation. Okay, it seems like when they are less correlated, even negative, the benefit that you can reduce your portfolio without sacrificing your expected return or return, okay, is greater. Okay, the way that you reduce you minimize your risk, okay, without sacrificing return, we call it as diversification benefits. Okay, so as you can see that the same expected return of 10% and 10% when I combine North Air and West Air, okay, I still get some diversification benefits that reduce from 13.4% to 12.1%. Okay, because the North Air and West Air, they are positively correlated, but they are not perfectly negatively correlated. So I can still get some benefit of diversification, but I get more diversification benefit when I combine West Air and Teck oil. All right, so you can see this is a kind of fact, and it's interesting to show you this. Okay, now let's use your high school mathematics. If you recall your high school mathematics, if you don't recall, you may study at university. Uh, the covariance, when you have the return a series of data or information about return of stock I and stock J, you can calculate something called the covariance. The covariance is the product of Ri minus ERI and Rj minus ERJ. When you have the covariance, if you calculate based on your historical data, and this is the formula. If you take the covariance of the return I and return J divided by each standard deviation, we can have something called the correlation. Okay, so nothing new. I just borrow the statistics formula, how we measure the correlation of the return I and return J. We can just simply compute the covariance of Ri and Rj divided by each standard deviation, the standard deviation of Ri and the standard deviation of the Rj. Okay, so just want to recall you that when they are perfectly positively correlated, it means the correlation is equal to 1. If they are perfectly negatively correlated, okay, they always move oppositely, and this one we have the correlation of -1. Okay, and this is a kind of between -1 and +1. If it's 0, independent roots has no tendency to move together and have 0 correlation. Okay, and if you between 0 and +1 tend to move together, and then when you have the 0 to -1 tend to move oppositely. All right, so this is a kind of another recall of how we measure the uh, how the information co-move the data or return co-move positively, co-move negatively. Now, if I use this formula, okay, and then I try to figure out this information, okay, I can calculate the deviation for mean and the portfolio, and then I calculate the covariance and I calculate the correlation. Okay, nothing complicated here. It's not finance. This is just only your high school mathematics. All right. So if I calculate, we can see that the information when you learn from this, we can calculate the correlation of the series of return of North Air and with the West Air stock return, you can see that the correlation between North Air and West Air is 62.4%. Whereas the waste air and tax oil is minus 0.71% or 713, which is 71.3% negative, right? Okay. Any question? Now you can observe something which is called diversification benefits. Okay. Any question? So far, so good? Good to go, Professor. Thank you. Everybody follows? I have learned from Lynn that some of you may not, study finance a lot before in your undergrad. So feel free to ask me question if you have question on it. It's not complicated. Okay. I have some student who never studied finance before. They got the highest mark when after the exam. For the exam. Okay, so after this, so what we can do is we're gonna try to, uh, you know, have a real, with the real data of the real company. Okay, before is a little bit hypothetical company stock returns. Okay, now let's go to Microsoft, Dell, Delta Airlines, American Airlines, General Motor, Ford Motor, Anheuser-Busch. Okay, these are like stocks, major stock in the U.S. Okay, where they are part of S&P 500. Okay, so if the data show here in this table, okay, that is I took it from your textbook, and you can see that the volatility, okay, of Microsoft is 42%, 54% for Dell, Delta is 50%, American Airlines 72%, General Motors is 33, Ford Motor is 37, and Anheuser-Busch is 18%. Very low risk. What is they do, this company? Anyone know? Anheuser-Busch? Somebody know? What is their business? They are in which business? Beverage. Okay, good. Beverage, beer, all those. Okay, so the beverage seems to have low return volatility than computer business, ally business, or automobile business. Okay, and after that you have the correlation of stock return of each one. Would you mind giving me 3, 4 observation from this? Okay, let's take this one like a masterpiece of Monet, of impressionist picture. Have you been in Paris before? Have you been to museum in Paris? I hope that the COVID will end soon so that you can travel to France or to Paris when the situation goes better. So when you observe this table, what do you observe? Just observe this table. Anyone can give me some interesting information, please? Last year when I showed this, one of the students said, "Oh, I see 1, 1, 1, 1, 1, 1 diagonally." Okay, so obviously the correlation of itself, the correlation between Microsoft stock return and Microsoft stock return should be equal to 1. Okay, this one I already observed. What else you observe from this? Me check some of people who can share your thought. What do you observe? One Tang Do is writing. What do you observe? Anyone observe something? I'm talking about the correlation. What do you observe? When you are the top CEO, you should be able to observe quickly. Company in the same industry tend to have positive correlation. Very good. Okay. So the correlation seems to be, the company in the same industry seems to have higher positive correlation. Okay. So it means if the market go badly, they'll sell less computer. Microsoft should sell less software of Windows to, they should, the return correlation is 65%. Same for Delta and American Airlines. Delta and American Airlines is 69%, 0.69 in the same industries. And you can see that when you look at this is the highest correlation. And then the General Motor and Ford Motor, okay, the correlation is also 64%. Okay, what does imply when you have high correlation? Company in the same industry tend have positive correlation. What does imply? One, Hang Do, or anyone else? Before I go to T2 Chang Fan for a next observation. From the first observation, if the companies or the stock in the same industries, okay, tend to have high positive correlation. What does this imply? It implies implication, when you have the high positive correlation, what the implication of that high positive correlation? It means diversification is what? Is diversification benefits, I can say, is smaller, okay, when you combine or you put, allocate or invest of stock in the same industry, okay, because in the same industry you have high positive correlation, right? So diversification is smaller, okay. You're gonna get more diversification benefits. It seems like you get more benefication benefit when you combine firm from different industries. That's right. Excellent. That is the first observation. I can see second uh, for observation, you say that Microsoft and Bosch have negative correlation. Beverage company has low correlation to all other company. Excellent. T. Hian Guyen. How many Guyen in your class this year? I heard that the Guyen is the name of the royal family. No? So you have million of royal family members. Empire, isn't it? Ah, I miss this kind of joke when we are in person. I can see you're laughing, you are, smiling. We always have this online. We cannot do much, but anyway, it's one of the most name over the world. So no surprise. Okay, okay. So, um, all right. So what we can see also, the second observation that you have seen here is that the Anheuser-Busch has very low correlation to other stocks, which is good or bad for diversification point of view. Is good or bad? Is very good. They is a the beverage company seems to a good candidate for getting the diversification benefit. Now we can approve it later on, okay? But it is interesting because they are less correlated with others. So when they are less correlated, like the way we derived earlier, when you have lower correlation, the diversification benefits are higher. Okay. All right. Let's go and calculate with the real data of these US stocks together. Okay. For example, if I want to know the covariance of the Microsoft and Dell, I have this correlation and standard deviation of the two stock. I would like to calculate the covariance because after I know the covariance, I can be able to calculate the correlation, or vice versa. I know correlation, I should be able to calculate the covariance. This question they ask, what is the covariance of Microsoft and Dell? I just simply take the formula earlier. Okay, the formula I'm talking about is here. Correlation is equal to covariance divided by E standard deviation. You want to know the correlation, I just simply take the correlation multiplied by standard deviation of each. Okay, so in that case, I'm gonna be able to simply calculate the covariance of the Microsoft and Dell, which is 0.1474. All right, now let's compute, okay? Let's derive the a two stock portfolio, okay? If I have only two stocks, stock 1 and stock 2, if I combine the two stocks together, okay, I should be able to compute the return of these two stock portfolios. Okay, so the expected return or the return of the two portfolio will gonna be equal to X1R1 plus X2R2, which is straightforward. Now, the combined risk of these two risky portfolios, okay, would depend on the covariance of each stocks or of the two stocks. Okay, so if I take the variance of the RP, it should be equal to covariance of the RP. Okay, this is the property of the covariance, the definition of the variance, right? So if I derive the RP, which is equal to X1 R1 plus X2 R2, and the X1 R1 plus X2 R2, and then I, solve this by putting the take X1 out, and I can get the covariant R1 plus X1 X2 covariant R1 R2 plus X2 covariant R2 plus X2 covariant R2. This is just simply mathematic proof. And then I'm gonna have the formula, and this is probably the formula that you're gonna use a lot in your exam. So if you want to highlight it, so the variance of your portfolio should be equal to the X1 square variance R1 plus X2 square variance R2 plus 2X1 X2 covariance R1 R2. Okay, or if I get the form of this covariance to the correlation multiplied by E standard deviation, I can get the variant of this portfolio, and I take the square root of this variant of portfolio. I can know the volatility of these two stock portfolios. Okay, let's take the data from Microsoft, Dell, Delta Airline, American Airline, and start to form a portfolio and try to see what is the level, what is the return of your portfolio when you combine different stocks in your portfolio, and what is the risk of the portfolios. Okay, shall we go? So let's start by looking at the portfolio with equal amount invested in Microsoft and Dell stock. What does this mean? Equal amount, meaning that the X1 equal to 50% and the X2 is equal to 50%, right? X1 is Microsoft and X2 is the Dell. Okay, so when we call equal weighted or equal amount investment, it means 50% and 50%. All right, 0.5 for both. Excellent. Once you have the 0.5, okay, you can just simply now to apply the formula to be able to calculate the return of the return. They don't have the data on the return, but they ask to calculate the volatility. So you can simply use the formula of the variance. So you can take x1 square SDR1 square plus x2 square multiplied by standard deviation R2 square plus 2x1 x2 correlation R1 R2 and multiply by E standard deviation. Okay, nothing complicated. You can just apply 0.5, which is the x1. Standard deviation of Microsoft is 42%. It comes from this. And Dell, the standard deviation of volatility is 54% plus 2x1 x2 correlation of 0.65, right? The correlation we can see here is 0.65. Okay, multiplied by each standard deviation. The standard deviation volatility of Microsoft is 42%, and the Del is 0.54. After calculation, I have the variance of my portfolio equal to 0.1907. The formula look complicated, but is not complicated at all, isn't it? For your exam, the formula is given, okay, are given. All necessary formula you don't need to learn by heart, okay? When we get the 0.1907, I take the square root of my variance. I'm going to get the volatility of my portfolio of 43.7%. Okay? Before you calculate it, if I take the data here, okay, I form my portfolio 1 between Microsoft and Dell. My portfolio 2, which is what? Dell portfolio 2 is Dell and Delta Airlines. Okay? If these both with equal amount, 50%, 50% of each, which portfolio 1 or portfolio 2 should have less volatility, even without data, right? So as you can see, the correlation between Microsoft and Dell is 0.65. Dell and Delta is 0.19. So therefore, the portfolio number 2, where you combine Dell and Delta Airlines, where they have less correlation, should get more diversification benefits, meaning that your portfolio should have lower volatility than the portfolio when you form Microsoft and Dell, okay, where the correlation is higher. Okay, let's check the portfolio Dell and Delta. I just simply apply the formula. Similarly, I can see that the variance of my second portfolio is goes to 0.1610. If I take the square root of this, I get 40.1%. So the portfolio 1 has the volatility of 43.7%. Portfolio 2 is 40.1%. And you can observe here, right, this term that related to the correlation. The lower, the term here should be smaller, right? If you have a negative, you can even reduce the, portfolio or the variance of this formula, isn't it? Okay, that is proved that the correlation play an important role in the diversification. Now, if you have large portfolio, you can do the same thing, or we don't do it manually, but if you are the fund managers, you can easily calculate the variance of your portfolio by taking, this kind of formula, okay? So remember when I showed you yesterday about the traditional stocks, okay? And if I can see here, the more I increase number of stock in my portfolio, okay, the level of my volatility of my portfolio should reduce. If I have 2, I have 5, I have 10, and then I have more and more. Okay, I have 500 and 500 and 1000. The volatility remain almost unchanged or very, insignificant change on those. It means like your diversification benefits that you reduce from this to this, okay? So therefore, this point 40% to 20 something, okay? This one should represent the idiosyncratic risk or diversifiable risk, where this one from this point to 0, this one should represent something called systematic risk or the market risk. So no matter what, you investor must bear that particular risk. Okay. All right. So this is how we learn how to combine a portfolio, how we compute the volatility of the portfolios. So far, so good, everybody. So far, so good. Perfect. Now, what I'm going to introduce you now is if you are investors, you have the universe of investment opportunities. Okay? So, what we are going to do right now is try to find out what is the efficient portfolio. Efficient portfolio means that the same a level or a given level of volatility, the risk that you take, you can maximize your return. Or as a given return, you can minimize your risk. Okay, and this one we're gonna call it of the efficient portfolios. Okay, so let's try to find a portfolio that is the efficient for you to invest. Okay, now again, everybody can just have a look on this. Okay, I have now 2 stocks to invest. Okay, just go for 2 stock first. The simple way to do so. Okay, I have this table. Anyone, would you please giving me some observations? You understand what observation means. Okay, I have okay, I represent Intel stock, and the C is Coca-Cola stock. Okay, can you give me the characteristics of Intel and Coca-Cola stock? Everybody know what is the characteristic mean? Is mean what is the expected return? What is the standard deviation or volatility of each stocks? Okay, so in other words, if I have Intel, what I want to know is what is the expected return and the volatility of Intel. I also want to know Coca-Cola, Coca-Cola stocks, which is what is the expected return and the volatility of these 2 stocks. Anyone can help me? Can I read from this table? What is the characteristics of Intel stock and what characteristic of Coca-Cola stock? Anyone? Do we have this information? Yes, we have. Where can we find this? Anyone? What is the Intel expected return and volatility of Intel stock? What is the expected return of Coca-Cola stock and volatility of Coca-Cola stock? Coca-Cola stock is 6%, standard deviation is 25%. Let me write it. I haven't checked it. Coca-Cola is 6%, and volatility of 25%. Intel is 26%, volatility of 50%. Okay, let me check. Okay, how did you know that? Man Tang Do or Quan An Le or Quoc Dong Fan? Would you mind turn on your microphone and tell me how you get it? I want to hear your some voice. I talk a lot, so long time. Are you allowed to talk? Yeah, I guess. I didn't mute your microphone, isn't it? Oh, I mute. Can you talk? Ti Chu Hian Guyan. Anyone want to talk? Just say hello. Can you talk? Yi Chun Hian Guyan, can you make your microphone on and explain to everybody how did you get that number?
Yeah, hi, Professor. Can you hear me?
Yes, I can hear you. Thank you very much,
Yeah.
Guyan. Hey,
Yeah.
how you get
Actually,
the data?
yeah.
How can you get the data of 26% and 50% of volatility for Intel stock and 6% and 25% for Coca-Cola stock?
Actually, you just need to take a look into the first and the last row of the table. The first row
Okay,
is when you have the 100% of Intel and 0% of Coca-Cola. That's why it's the expected return and volatility of Intel. And for the
perfect.
last row is for the Coca-Cola.
Perfect. Thank you so much. Everybody follows? Okay. So as you can see here, the portfolio weights, right? If you put 100% on Intel, 0 in Coca-Cola, actually the first row represent the characteristics of Intel stock, where the last row, it means that Coca-Cola, okay, you put 100% in Coca-Cola stock, it means that you invest 100% on Coca-Cola stock and 0% on Intel. It means that the last row represent the expected return of Coca-Cola stock, which is 6% and volatility of 25%. Okay, so how can we say something on Intel and Coca-Cola? How we characterize it? Just want to repeat what we heard at the beginning of the class. Chi Chun Hian Guyen, can you tell me one more time? Can we say something on Intel Coca-Cola? If you have my investment advisor.
Yeah, Intel is for the risk taker. It's have the higher volatility and higher return. And Coca-Cola has the lower volatility and as well as the lower return. That's why it is
Perfect.
for the risk adverse person.
Okay. So Intel Coca-Cola, Intel has, thank you very much. Perfect. Intel has higher return and higher expected return and has higher volatility than Coca-Cola stocks. Okay. So obviously it depends on risk preferences. If you want to hold only individual stock, okay, to choose between Intel and Coca-Cola. But today we learn how we form a portfolio. We can probably be able to identify different scenario of your investment based on different weights between Intel and Coca-Cola. Okay, so let's do the different scenario of different weights on Intel and Coca-Cola. Okay, and then we're gonna draw the, the profile of risk and return. Okay, in different way on investing in different ways. Okay, let's go back to our slide here. I have 1, 2, 3, 4, 5, 6 scenarios. Okay, these 6 scenarios. Okay, the first one I put 100% in Intel. And second, I put 80% in Intel, 20% in Coca-Cola, 60% in Intel, 40% in scenario 3, scenario 4, 5, and 6. Okay. Do you observe something? So if I put different weights, so I calculate exactly expected return and volatility. Okay. So how I get this number? Everybody know how to get this number if I don't show you this table. The very simple is come from this formula, right? You have a return of Intel, you have a return of Coca-Cola, you have the the standard deviation of Intel and Coca-Cola. If you know the correlation of Intel and Coca-Cola, you're gonna be able to calculate exactly to put in this table for you. Okay. So after this, what you can see here, I have expected return of 26%, 50% of volatility if I hold 100% of Intel. If I reallocate 80% in Intel, 20% Coca-Cola, my return reduced from 26% to 22, but my volatility also reduced from 50% to 40.3%. It depends on the choice. Now I have not only one extreme of holding only one, but I can combine different weight. If I combine 80% and 20%, the characteristic of my portfolio change. Okay. And at 60%, 40%, 40%, 60%, 20%, 80%. What do you observe here? There is a kind of one stupid investment that you should avoid from this table. What is it? What is the stupid investment if you do so in these 1, 2, 3, 4, 5, 6? Which scenario you should avoid? Anyone? You should avoid the sixth one, which is investing 100% in Coca-Cola. Why? Why that so? Anyone? The last one, because okay. Mantang Do, you want to talk? Can you explain why is that so?
Yeah, hi. By choosing 40% for Intel and 60% for Coca-Cola, you have higher expected return with the same
Exactly.
policy.
Exactly. So if you look at the portfolio number 6 with the portfolio number 4, okay, you can see that with the same level of volatility of 25%, the portfolio 4 provide you generate 14% exact return, where the portfolio 6, where you put 100% in Coca-Cola, you get only 6%. So we're gonna call that the portfolio number 6 is inefficient. All right. So inefficient, meaning that with the same level of volatility, you can maximize your return, get a higher return. So this portfolio 4 should be more efficient than the portfolio 6. And then we call that portfolio 6 is inefficient. Okay. Now, if I draw exactly, the calculation we have just made, and you can see here, I have the red and the blue. I have different weight. Okay, I have the volatility and return. Okay, and then I plot this portfolio. I can see here on the red zone is the zone where the efficient portfolios, are still efficient, just only has different level of risk preferences. If you are the risk preferences to get the highest volatility to maximize your return, you may hold Intel completely. But if you are an investor who prefer a little bit lower volatility, because each investor may have the risk capacity to hold different level of volatility. So therefore, you can move along this one. okay, among these frontier, okay. And then after that, you can see here, you start to get the zone where you are in the efficient portfolio. Okay, between 20% in Intel, 80% in Coca-Cola to 100% of Coca-Cola, all these frontier of your investment profile, okay, are inefficient. Okay, you understand what inefficient means? It means like if I take the level of my volatility of, for example, Coca-Cola of 25%, I can cross, up to the red line. I can see that I can maximize my return, okay, if I allocate 40% in Intel and 60% in Coca-Cola without bearing additional risk. I can maximize return, okay, and this make my 40% and 60% efficient portfolio. All right, so now any question? Perfect. I really enjoy teaching your class. You're great. Perfect. Do you need a break? May I ask this question? Yes, ask question. What is your question? Before we have a break, Guok Dong Fan, you can make a microphone on and ask me if I want to calculate portfolio of 4 stocks. Okay, I create 2 portfolio each with 2 stock and calculate expected. Actually, it's exactly the same. Just only that when you do 4 stocks, okay, you need to get more complicated mathematic formula. You cannot use just only this formula. I have seen, yeah, I think, where is it? Let me see. Yeah. So normally you should use some programming to be able to form a large portfolio. You should not do it manually. But the similar things, the same concept, and then they have a lot of software or tools that allow you to form the portfolio and calculate the portfolio risk and return. But you should not do it manually. In the exam, I gonna do it only 2 stock maximum. Okay, because more than 2 you need some calculation. It's better to put in Excel spreadsheet and calculate it. All right. So, but the portfolio of the 2 portfolio of combined, you're gonna get the 4 stock portfolio. But the calculation is not simple as the 2, because you have the covariance of stock 1, 2, 2, 3, 3, 1, 1, 2, 2, 3. So you have to put everything together, and better to make it in the spreadsheet and the programming to be able to calculate the whole covariance and to get the complete calculation of the portfolio of 4 stocks. Okay, or if you take the portfolio theory in another investment class, you probably have some, other tools to do so. Okay, many of professionals who are, expert in this, sometimes they use software or they can write MATLAB directly on by themselves, but don't do it manually. Okay, it's not easy to do so. Do you need a break? I need it. Okay, shall we have a break now? Okay, 15 minutes, and then we come back. I showed you, I don't know whether you can see it in my apartment. Normally you should see, this crowded. You should see the Eiffel Tower. You see Eiffel Tower? Probably not. Oops. Should be somewhere. Where is it? Do you see the Eiffel Tower? You see the Eiffel Tower? Yes, you see? Okay. I leave the camera on so you can enjoy the Eiffel Tower, which is a little bit, you know, far away. Okay. And then I see you in 15 minutes. All right. I pause recording. Continue my recording. Okay. So let's now working on, so if you can see here, you can see the portfolios, efficient portfolio, inefficient portfolios of the two stocks, portfolios. Okay, so let's now taking example on how you can improve return with efficient portfolios. Sally Faison has invested 100% of her money in Coca-Cola stock and using investment advice. She would like to earn highest expected return possible without increasing her volatility. Which portfolio would you recommend? We have already talked about this, okay, by putting 40% in Intel, 60% in Coca-Cola with the same volatility, which is equal to holding Coca-Cola stock alone, would allow Sally to get a better, a higher expected return, okay, from what? From 6% to 14% here, right? With the same volatility. So as you can see, remember we have seen several cases on the you know, correlation and the effect of the correlation when you combine two stocks. And you can see here the correlations, if it's equal to 1, it means like you won't be able to gain diversification benefits. The higher, or the way you move it on this straight line, the higher volatility, you're going to get higher return, high risk, high return, and so on and so forth. But if the correlation is lower than 1, and you can see here, you start to have the, you know, a better efficient portfolios with the with a better allocation of your investment, and then you're going to get the maximum of diversification benefit if the two stock has -1 or negative, perfectly negative correlated. So you can even try to find a portfolio where your volatility goes down to 0 and you get this return. The economy that you have almost here is represent the risk-free rate in the economy. Okay, so we're gonna get some of those you know, example later on. Right now, let's form a different type of portfolio. Okay, let's assume that right now I have a portfolio P. If I want to combine the risk-free asset with the portfolio P, okay, what can happen? Okay, so as you can see here, if I take ERXP, XP means I invest, okay, I put weight of my investment X in the P. Therefore, my 1 minus X should go to the risk-free. From this first line, everybody follows. Everybody follows? So I put X in the P and 1 minus X in the F. F means risk-free assets. Okay. So after this, I can derive, okay, from this RF minus XRF plus XERP. I rearrange it. I'm gonna get RF plus XERP minus RF. That would gonna be my expected return of this portfolio, where I put X in the P and the remaining, what my minus X, I put in the risk-free asset. Okay, so what's going on is that when you combine this, the volatility of the portfolio, Okay, if I take the same equation on those variant equation, take the square root of this, I get, you know, x1, which is 1 minus x, x2 is x. Okay, I combine all these, I gonna get the square root of x square variance RP, which gonna be x SDRP, meaning that the standard volatility of your portfolio where you put X in the P and 1 minus X in the F, you're gonna get easily direct calculation that allow you to get X multiplied by the SDRP to get that volatility of that portfolio. This risk return combination of the risk-free investment and the risky portfolio lie on the straight line connecting the two investment that allow you to reallocate the investment to the level of risk you want to take and try to find a maximum return. Okay, so meaning what? If I take my, you know, frontier efficient portfolio of risky investment, so what I can do is I can see here on the you know, blue line, and this blue line come from this formula. Okay, and this blue line, as you can see here, if I put 100% in the P, I gonna be in this point. Okay, if I put 50% in the P and 50% in the RF, I gonna get this point. Okay, investing in the P and the risk-free investment. If my X is equal to 0, I gonna have everything 1 minus X in the risk-free investment, which is this point. Okay, now if I invest X beyond 100%, so it means that I gonna buy P on the margin. It means I can borrow the money and invest in this line. I gonna borrow at the risk-free rate and invest 150% in the P. If I go this point, you're gonna go to the X equal to 200%. Okay, when the X, the weight of X is bigger than 100% in the portfolio P, it means you require the borrowing at the risk-free rate of this, okay, of this investment. So far so good. Okay, so now let's define, okay, the what we call the tangent portfolio. What is the tangent portfolio? Since investor is seeking to earn the highest possible expected return of any level of volatility, okay, that basically what investor interested in is to find the highest slope of this line, right? The higher the slope, okay, the higher, you know, return as the given volatility, okay, you should get. So therefore, the investors, okay, should seek to earn the highest possible expected return for any level of volatility, okay, that the portfolio can generate, the steepest possible line when combined the risk-free investment. And the slope of this line is known because it's defined by Professor Sharpe, who got the Nobel Prize in economics, okay, which is called the Sharpe ratio. What is the Sharpe ratio? The Sharpe ratio represents the portfolio excess return, which is the ERP minus RF divided by SDRP. In this Sharpe ratio would allow you to compare, for example, which one is more interesting. The higher Sharpe ratio, the better for investors. Okay, so let's define also that in the efficient portfolio, okay, we can name it as the tangent portfolio. And this tangent portfolio is a portfolio that has the highest Sharpe ratio. This is the theoretical definition of the tangent portfolio, the best of the best, right? The efficient portfolio, which is tangent portfolio, is a portfolio that gives you the highest Sharpe ratio. Okay, so if I take the blue line, and you can see in the blue line, if I move to the green line is better than the blue line, isn't it? Because this green line would allow at the given level of, let's take the 12%, you can see that when I touch the green line, the return is higher when I touch the blue line. So therefore, the tangent or efficient portfolio should represent this green line. The tangent portfolio is a portfolio with the higher Sharpe ratio investment on the green line, connecting the risk-free investment and tangent portfolio, provide the base return trade-off available to an investor. As a result, in tangent portfolio is also referred as the efficient portfolio. Okay, so now you have before, okay, let's give the example. Before you have Sally, now if you have your uncle, okay, your uncle asked for investment advice. Currently, he has $100,000 invested in a portfolio P, and this portfolio has an expected return of 10.5% and volatility of 8%. Suppose the risk-free rate is 5%. The tangent portfolio has an expected return of 18.5% and volatility of 13%. Assume that we know the tangent portfolio, right? Tangent portfolio is an efficient portfolio, as I told you earlier. At a given level of volatility, you should get the highest return. So if you take the 100% in your tangent portfolio, you're gonna bear volatility of 13%, you get return of 18%, which is probably not exactly what your uncle wants, right? Your uncle wants first, he wants to maximize expected return without increasing his volatility. At the moment, his volatility is 8%. Okay? You cannot just simply reallocate your portfolio P of your uncle to the tangent portfolio. Make sense? What we can do is you can combine the tangent portfolio with the risk-free asset investment. Okay? What I can do is I can simply take this formula. My first formula that I have is RXP should be equal to the RF plus XERP minus RF, and then I have SDRXP is equal to the XSDRP. Okay, now this formula I can apply that to the ERXT. So I'm gonna move the P to the T, and then I allocate the X, the T, and then 1 minus X, I can go to the risk-free assets. Okay, let's do that together to be able to help to answer your uncle, right? And then that is the first one. The second one, he also needs your recommendation to make an investment so that he can have same expected return, but probably bear lower risk than the 13% that he has or 8% that he has at the moment. Okay, so let's go to the first one. Okay, when you start to read, I recommend you to write form the problem in equation or in variable, which is probably easy for interpreted, easy to put in the formula later on. Okay, let's read together. $100,000 is investment. Okay, and this portfolio has an expected return of 10.5%. Somebody can help me how to write 10.5%. So it should be the XRP, okay, should be equal to 10.5%. Okay, would you mind everyone take a piece of paper and you help me to write it down, what you can write from the problem. Okay, so you have your portfolio P. So I have my P portfolio. I have expected return equal to what? And then I have the standard deviation of my portfolio. Anyone can write the characteristic of the portfolio of your uncle? Please? Anyone? So my expected return of portfolio, and then I have the volatility of my portfolio P. Yes? Anyone? Everybody sleeping? No one? Are you sleeping? Are you dining? You have you're eating at the same time? I cannot see your camera, so I don't know what you're doing. So anyone can help Guyan, Hong Lian View? So you're typing. Are you sleeping? So you have portfolio has an expected return of 10.5% and volatility of 8%. Would you please help me what to write? Hello, hello. You enjoyed too much the Eiffel Tower. Ang Dung Tran is writing. Anyone, please? Are you tired, isn't it? I promise I will finish earlier. Okay. Thank you, Han Dong Tran. So the expected return of the portfolio 10.5 and SDRP, which is volatility of this portfolio P, is 8%. Okay. Anyone help me to write the tangent portfolio? So it means what is the ERT equal to what, and SDRT is equal to what? ERT, which is the tangent portfolio, has an expected return of 18% and volatility of 13%. Perfect. Okay, so you have these two information. What next? Okay, the next is they want to know how you're gonna reallocate so that your uncle expected return, okay, can increase without increasing his volatility. So what you're gonna do is you're gonna combine tangent portfolio with the risk-free asset, meaning that you're gonna try to find out what is the expected return of your XT would be equal to what? Okay, if your standard deviation of your RXT, okay, is equal to 8%. Everybody follows? You follow? Everybody follows. Okay, I'm gonna reallocate the investment of my uncle investments from the portfolio P. I'm gonna choose the tangent portfolio to invest for my uncle, but I don't want to put 100% in the tangent, because if it's a tangent of portfolio, you're gonna get the the level of risk is just higher than 8%, right? Because the volatility is 13% of the tangent portfolio. So what you have to do is you're gonna combine the T with the X, okay, and then 1 minus T to the risk rate. That makes sense? So to be able to do so, it's very simple. I can just simply apply this formula. Okay, since I have the formula 1, which is this one, and this formula 2, I can start with the formula number 2, where the formula number 2, I gonna be able to get X equal to maintain volatility of 8. It means that I gonna put 61.5% to invest in the T, and the remaining of my investment to the risk-free. That would allow us, okay, to get the expected return to the 13.3%. Okay, 13.3% come from that you invest 61.5% in the tangent portfolio, and remaining of 38.5% in the risk-free investment. In this case, the portfolio of your new portfolio allocation will gonna give you the volatility of 8%, but with the expected return of 13.3%, which is better or not? Obviously, it is better, because at the moment your uncle bear 8% of volatility, but he earned only 10.5%. With your new allocation, your recommendation will increase from 10% to 13.3% without increasing the level of volatility. Okay. Similarly, if your uncle preferred to keep expected return, okay, meaning that he want to get 10.5%, and whether you can be able to reduce the volatility from 8% to the level that is lower than 8%. Okay, so now the same equation, you can start by the expected return. Okay, if you take this expected return equal to 10.5%, so you're gonna be able to get the X. The X will gonna be 70.7%, and the remaining of those 59.3% will go to risk-free investment. And after that, you can see that if you put 40.7% multiplied by 13%, you're gonna be able to get 5.29%, which is lower than the 8%. So your uncle is better off, okay, to have this new portfolio where he can keep the level of return, okay, at 10.5%, but he bear right now the risk of 5.29%. So far, so good? Yes? I should not have a break, no? It seems like after you break, you become less active. You're more tired, which is normal. Huh? It's very late over there. I just have my instant noodle during the break. I have for my lunch. So I suppose that you're also having dinner during the break. Okay. So that is about the portfolio and the combination of the portfolio and so on and so forth. Okay. Now, what I would like to do is to introduce you a very important concept that derive from these optimal portfolio theories, okay, and developed by several economists. Some of them got the Nobel Prize, like Professor Sharp and others. So they have working on something called the capital asset pricing model. The idea of our class, I'm not going to derive mathematically, but I just rather introduce you what the model is about, how we can apply this model in the real world of corporate finance or finance in general. Okay, so the concept is very simple. Okay, these look simple when I explain to you, but to be able to get this one is a lot of mathematical work and proof and so on. The idea of the CAPM, starting from that they make some assumptions. Okay, for example, they assume that the market portfolio is an efficient portfolio. Okay, such as S&P 500 in the US can be considered as an efficient portfolio in the US stock markets. All right, and the way that we are going to talking about is the line where we can optimal our investment, and this line that optimal our investment, we can call it as the capital market line, okay, or the CML line. How do we identify the efficient portfolio? To identify the efficient portfolio, we must know the expected return, volatility, correlation between investment, their quantity are difficult to forecast. Further, investor belief may differ and not necessarily known by the firm. Under these circumstances, how can we determine the efficient portfolio? So the CAPM identify that the efficient portfolio is as the market portfolio. Basically, they use the market portfolio as a proxy of the efficient portfolios. And then after you assume this, you must also make some assumptions. For example, in this model, there is no market friction. It means everybody can buy and sell, and there's no spread between buy and the sell price, and everybody will be able to buy and sell all security at a competitive market. No taxes involved, no transaction costs, okay, such as the trading spread, and everybody can borrow and lend at the risk-free interest rate. Okay, that is a kind of major assumption to make sure that mathematically you can solve it. Investor hold only efficient portfolio of traded security, portfolio that yield the maximum expected return for a given level of volatility. Investors also have homogeneous expectation regarding volatility, correlation, and expected return of securities. Okay, just forget for a while of the assumption we use look very theoretical. Let's go to the graph that we have just learned, okay, after we introduce you the Sharpe ratio. And you can see here just simply that when you assume that the market portfolio is an efficient portfolio, you're going to have this green line. And this green line, okay, where you assume that the market portfolio is an efficient portfolio, we call it as the capital market line. Okay. And interestingly, that this capital market line is the line that you can optimize your investment. So if I take the same formula, okay, of the tangent portfolio, so basically the CAPM, I just replace the T with the CML, right? So using the market portfolio as an efficient portfolio, okay, so ERX-CML will gonna be equal to the RF plus XERM minus RF, and SDR-RX-CML equal to the XSDRML, okay, our market. All right, so let's give example. Now, it's not your uncle, but your brother-in-law. You know your brother, what is a brother-in-law means, right? The husband of your sister. Okay, your brother-in-law investment portfolio consists solely of 200,000 invested in McDonald's stock. He loves McDonald's, and he invests all his money of 10,000 investment in stock market, only in one stock of McDonald's. Okay, you can see that your brother-in-law seems to be not the most intelligent one. Let's check. Okay, suppose the risk-free rate is 4%. McDonald's stock has an expected return of 9% and volatility of 27%. If the market portfolio has an expected return of 10% and volatility only for 16%, under the CAPM assumption, which portfolio has the lowest possible volatility while having the same expected return as McDonald's stock, which portfolio has the highest portfolio expected return while having the same volatility as McDonald's stock. Very similar to the exercise we have done earlier. Okay, just simply the difference is that you now don't take the tangent portfolio from Sky because it's difficult to measure of those tangent portfolio, but you can just assume S&P 500 or market portfolio as an efficient portfolio. And then you can plug in the formula of expected return of X CML. Everybody follow? You put X in the CML and 1 minus X in risk-free investment. Okay, you're gonna get this formula. Okay, and this formula is gonna be equal to 4% plus X 10% minus 4%. If you want to keep 9% of expected return equivalent to McDonald's return, okay, by investing X in the CML and 1 minus X in the RF, that can generate 9 return. So you need to put X 0.8333, okay, in the market portfolio, and 1 minus 0.833, you buy the T-bill or risk-free investment. Okay, so if your brother-in-law has these 10,000 investment in McDonald's stock, you're gonna recommend him to stop doing so. Just simply put 88,333 in the market portfolio and 1,667 in the risk-free investment. And this portfolio will gonna generate a return of 9%. Okay, but the volatility will gonna be equal to 0.8333 multiplied by 16%. Okay, the new investment will generate 9% of expected return, where you're gonna bear only 13.3%, which is what? Much lower than 27% earlier. That makes sense? Yes, that makes sense. Yeah, perfect. At least one reply me. Now, if I want to have volatility of 27%, what should I do to be able to maximize my return? Okay, by combining the market portfolio and the risk-free investment. Okay, so as you can see that if I put 100% of my investment in the market portfolio, my volatility is only 16%. Okay, I want to get 27% of the risk. Okay, what should I do? I should go beyond 100% of my investment in the market portfolio, isn't it? Otherwise, I cannot increase my level of volatility. Okay, right now is here. You want to get the level of how much? 27%. So you want to move here to 77% here. Okay, so what you have to do is you can borrow the money at the risk-free rate and invest more in the market portfolio. Okay, mathematically, I can simply calculate it, okay, by taking what? By taking the formula of my volatility, and as you can see that 27% equal to the X 16%. So if I take X, we're gonna be equal to 27% divided by 16%. So X we're gonna be 1.6875. When is bigger than 1, okay, everybody understand it means that you're gonna need to borrow more and invest in the market portfolio. Okay, so by doing this, you can see that my expected return RxCML we're gonna be equal to the RF of 4% plus 1.6875 multiplied by 10% minus 4%, which is equal to 14.1%. So with the expected return, with the given of volatility of 27%, I can alternatively, okay, manage in such a way that I can increase the return from what? From 9% to 14.1%. All right. Everybody follow. Okay, if I show it from the graphic, okay, McDonald's stock trade-off, okay, between the return and volatility is here, 27% and 9%, okay? The idea of bringing the same level of return by minimizing risk, okay, is gonna go from this arrow. Everybody follow? Can you follow? You follow here, so I can keep the same expected return, and then I gonna go to touch the green line with the CML line. I gonna go to this point where I invest 83% in the market portfolio and the remaining in the risk-free rate. I gonna be able to have exactly the same return of 9%. However, the volatility will bring down to the new level, which is much lower than holding McDonald's stock. All right. So similarly, with the same level of 27%, if I want to maximize my return, I need to get 169% invested in the market portfolio, which is go to this point. All right. So actually, it is not complicated. It's just only that it's almost the same as a tangent portfolio, where it's very hard to find the tangent portfolio, and the CAPM assume the market portfolio as an efficient portfolio, and then you apply exactly the same principle. Okay. So again, what I just said is very important for me, for you to understand the concept, but we will not go in detail on how to solve these mathematically, where if you take the, portfolio class or other advanced classes, you may see the CAPM in a different version, right? My version is more corporate approach version. Now, these CML line and these the relationship is helping the CML, which is the capital market line, allow us to develop a theory that related to what we call the CAPM, capital asset pricing model, that allow us to determine the risk premium of an investment in a stock, okay, that we gonna determine the measure, the new measure of risk, instead of going to take the standard deviation of volatility. We can measure the risk in the form of market risk, okay, which is the beta. Okay, the expected return of investment based on this beta with the efficient portfolio, the volatility of the capital market line portfolio. So basically, the the CAPM, you can write it that expected return of the stock I here, okay, should lie in this capital market line. And once you get all these market line, you can have a slope, and this slope is called the beta. If you multiply the beta with the market risk premium, okay, the market risk premium, which is ERM minus RF, okay, ERM is market expected return, right? Minus RF, we call market risk premium. Everybody follow? Let me write it for you, for people. So when you have this terminology, it means the market expected return. Okay, if I write ERM minus RF, we can call it market risk premium. Okay, the excess return beyond the risk-free rate you can get from market portfolio, we call the market risk premium. Okay, so if I take the market risk premium multiplied by the beta, this beta would multiply by the market risk premium, you're gonna get something called the risk premium for security I. If you plus the risk-free rate, you're gonna be able to get the expected return of the stock I. Okay, so you're gonna have the, and this one we call the CAPM. Okay, the first formula here is you use all the time. You can just highlight it, which is called the capital asset pricing model. The expect capital asset pricing model would allow you to derive the relationship of risk and return of an individual stock. Okay, for example, if you have Amazon stock, okay, you want to calculate to buy Amazon stock, what is your expected return of holding Amazon stock? Okay, so what you have to do is try to find out what is the beta of the Amazon stock. Okay, once you know the beta of the Amazon stock multiplied by market risk premium, you're gonna know what is the additional return you should get from holding, okay, Amazon stock. Okay, so the ERI should be equal to the RF plus beta I multiplied by the ERM minus RF, and this one we call the CAPM. Okay, so how we measure the beta? What is the beta? The beta is represent what? The sensitivity of your return of stock I in relative to the market. Okay, so basically the beta we can measure by the covariance of the RI and RM divided by the variance of the RM. If I put the covariance is equal to correlation multiplied by E standard deviation, and variance is the each the standard deviation of the RM square, I can take it out on the top and the bottom, and I can get these formula for the beta. All right. If you understand the concept of the beta, let me check your understanding. What is the beta of the market portfolio? The market portfolio, how sensitive of the return of the market in relative to the market? The beta should be 1, isn't it? The risk-free return is known in advance, is no volatility, no correlation with the market. So therefore, the beta of the T-bill of the risk-free investment should be equal to 0. Okay, when this one is 0 of the beta, and then the RF should be equal to the RF. That makes sense. Okay, so let's go to, example. Suppose the risk-free return is 4%. The market portfolio has an expected return of 10%, volatility of 16%. Campbell Soup stock has a 26% volatility and correlation with the market of 0.33. What is the Campbell Soup's beta with the market? Under the CAPM assumption, what is the expected return? So this is very simple. As long as you know the formula of the beta, okay, you should be able to calculate the beta. So before I apply the formula, would you mind helping me to write what you have read here? In the exam, I strongly recommend you to do like the way we are doing now. It means you write, you read first, and then you write. If you don't know how to write, you reread, and then you write. If you still don't know how to write, you try to write. Okay. All right. So let's write together. Anyone can help me to write? So I have some few slides to go, and then we stop because maybe you're tired today. Okay, because it's quite heavy today of the chapter 11. You learn a lot of concept in a very short period of time. Is very normal. But don't worry for the people who don't, follow everything. Tomorrow we're gonna do more exercise. We're gonna repeat what I have just talked, and then you will understand it for sure. Okay, so let's write first. Anyone could help me how to write from this problem? Risk-free return is 4%. How you gonna write it? Risk-free, it means RF. Anyone can help me to write RF equal to 4%. Thank you, Hong Len Biu Guyan. Okay. ERI is 10%. What is the ERI? Okay, the I is the Camel Soup, right? Expected return of, no, the market portfolio has an expected return of 10%. What is that? There's some correction here. Market portfolio has the expected return of 10%, like S&P 500, volatility of 16%. Okay, so it should be the ERM equal to 10%, SDRM equal to 16%. Perfect, Guyan. You're gonna get 20 out of 20. Okay, next, what you gonna write? So you read the Campbell Soup now. Let's take the Campbell Soup as the I, right? The Campbell Soup has 26% volatility. What is that? Campbell Soup. How are we gonna write it? Anyone else? How are you gonna write it? E-R, Campbell Soup. You have expected return, RCS. Seems you missed something. What is expected return on the Campbell Soup? No, you don't have it? They're asking. Exactly. So the volatility of the Campbell Soup is 26%. The correlation is 0.33. So then next, we're gonna be just simply, take the formula of the beta here. Okay, I can have SDRI. The beta is the SDR Campbell Soup multiplied by the correlation of the RI and RM divided by the SDRM. Can you plug the formula and then make a calculation? So the beta would gonna be equal to what? SDRCS would gonna be 26%, 0.26 multiplied by SDRI, which is 0.26, okay, multiplied by what? Correlation 0.33 divided by the SDRM. SDRM is 0.16. So that would gonna give us the beta of the Campbell soup. Okay, the beta of the Campbell soup is 0.54. Everybody follows? Okay. After I get 0.54, I gonna be able to get the expected return of 0.56. So we can have RF, which is equal to 4% multiply plus 0.54 multiplied by 10% minus 4%, which is 6% of market risk premium. Okay, 6% of market risk premium of multiplied by 0.54 should represent 3.2%. The 3.2% represent the risk premium of the Campbell soup stocks. Okay. All right. So after this, probably this is a little bit a lot. Let me check what kind of exercise that I can probably propose to you guys. Tuk, tuk, tuk. Pum, pum. Oh, basically you can be able to do everything until question number 7. So I feel like you're a little bit tired. I'm also tired, and I think we have a lot of things to do. I don't need to finish all the slide of these at the moment. So what I can do is to propose you to have a look at the moment, the problem set. Okay, let's go together on the problem set. We have the question number 2, which is about the portfolio, weight and so on. Question number 3 is about the combining the two stocks together. And then question number 4 is same. Question number 5 is the CAPM. Number 6 also CAPM. Number 7 also the CAPM. So you have now you should be able to solve the question number 2 until the question number 7. Okay, and then I would suggest that we stop classes now, because I think that is a little bit a lot for you guys. And then I still have a little bit ahead of schedule. I can come back a little bit later on to show you this graphic, okay, tomorrow, and then solve some problems together on the problem set. Okay, why don't we stop today a little bit earlier? Okay, what I would like to advise you is first to read what we have studied today, and then try your best to go for question number 2 to question number 7. Okay, and tomorrow we're gonna correct it together. Okay, I prefer to go slowly for not slowly. We are quite a good shape in terms of teaching planning I have in mind. Everything is just on time, but I feel like some of you may feel is a lot of things you learned today. I will stop the new slide. We can finish it tomorrow, but you should start to look at the question number 2 to question number 7. And tomorrow we correct it together and we finish the slide of chapter 11 together. Okay. So I think it's probably better. We have a little bit long day today, but I think it's fine. It's quite interesting, isn't it? Before we go, I would be very happy to answer your question if you have. Do you have any questions? Can you bring your calculator with you tomorrow? Because especially for the people who don't have time to do the exercise at home tomorrow, and if you don't worry, you will be able to study. I can give you solution. We're gonna work together. Everything should be, should be fine. Should be all right. In real life, how can I invest in the market portfolio? Very simple. You're not investing in the market portfolio. So either you put allocation, you look at how the market portfolio working on. Otherwise, you can do a lot of we call the ETF. You heard something about the ETF? Anyone know anyone working in the investment area? You can buy. Do you know what is a mutual fund, right? Everybody know what is a mutual fund? Yes, you do. Okay, they have several mutual funds that propose, okay, the investment that they replicate the market index. Okay, for example, you can choose the mutual fund that they can invest for you exactly as the S&P 500. You can choose the mutual funds that allow you to invest exactly like a NASDAQ composite index. That is the way we can invest in real life exactly of the market portfolio you choose. So you have different type of market index you can choose. For example, myself, I don't have time to trade all the time. So I invest part of my investment. I just invest in S&P 500, and then I let the fund manager who sell these ETF mutual funds that they propose to replicate the S&P 500, and then I would expect exactly a return of the S&P 500. To answer your question, Han Dong Tan? Yes. Yeah. So that is you can invest at the moment at any index around the world. I guess in Vietnam, you may have also some who propose that type of fund that allow you to invest. Sometimes they hedge also foreign exchange. They do many type of funds that you can invest that's similar to the market portfolio. Otherwise, you can do by your own market portfolio investment, and you can take the index of market portfolio. They know how to calculate the market, and then you reallocate your money to those stocks that represent the Hanoi stock market index, those kind of thing. Okay, but I am 100% sure that in Vietnam you should have some securities that propose those kind of ETF or mutual funds that allow you to get exactly as a Hanoi index or Ho Chi Minh City index stock index. Any other questions? I liked your question because it's bring you to a new perspective. It's not just only the calculation and theories. And next time, I try to see whether I can find some interesting news related to Tesla, to something new that is probably we can discuss, so that you can get some idea. You can, you know, think about the theory that we learn in class to the real life or the real world, okay, so that you can understand better. Otherwise, I wish you a great evening. I hope you enjoy today class as yesterday class, same, okay? And you'll be enjoy more in the future with me, and then look forward to meeting you again tomorrow, okay? If you have time, make the question number 2 to question number 7. You should allow the content we learned today should allow you to do all those questions. All right. Have a great evening, and then enjoy your dinner with your Saigon beer, Hanoi beer. Okay. Thank you. Have a nice evening. See you tomorrow. Bye-bye.